Often this is the case, and but certainly I apologize for this lateness. Where's the? Okay. First, I want to thank you for joining us here today to receive this report on the state of affairs of the Commodities Futures and Trading Commission. We're happy to have Chairman Giancarlo with us today. Thank you, Mr. Chairman, for being here. And as this is our first subcommittee hearing, I look forward to a productive Congress alongside the distinguished ranking member and my fellow Georgian, Mr. Austin Scott. But before we start, I want to take just a second to reflect on the loss of Mr. Bart Shilton this past weekend. He was a good man, a great man, and those of us who have been on the committee for some time know Bart from a career that spans the USDA, Farm Credit Administration, the Farmers Union, and both the House and the Senate. But everyone knows his contribution as a commissioner at the CFTC. He was a strong advocate for transparency and common sense in regulations, and we will miss him very, very much. Now, the CFTC was established as an independent agency outside of the Department of Agriculture through the Commodities Futures Trading Commission Act of 1974. The Commission states that its mission is to foster open, transparent, competitive, and financially sound markets. Dodd-Frank was passed as a result of the financial crisis and expanded the CFTC at that time to regulate swaps. Title VII of Dodd-Frank added safety and soundness to the markets by including market transparency and required clearing. Challenges facing the CFTC today are final implementation of Dodd-Frank, cross-border issues, and new technologies such as automated trading and cryptocurrency. For 2019, the CFTC is funded at $268 million. In FY 2020, the Commission is requesting a total of $315 million. This budget request consists of two separate requests: the annual Commission operation funding of $284 million and a new request to support the relocation of 3 regional offices at $31 million. It's also worth noting the purview of the CFTC in real terms. The total nominal value of the U.S. swaps is $282 trillion, and U.S. futures are at $27 trillion. That's real money, and it conveys real weight to what we have to do here. And for years, I've tried to draw attention to the very large job the CFTC has, and I've been a longtime supporter of increased funding for the CFTC, and I hope our subcommittee and the full committee and the entire Congress will see the growing responsibilities of the CFTC, and it's important that we give them adequate funding. Now, there is another issue I want to raise, though, and it's an important one. Yesterday, CFTC Commissioner Rostin Benham sent a letter to the CFTC's Office of Minority and Women Inclusion, detailing the diversity and representation profile of the senior and executive staff at the Commission. He lays out some troubling numbers and ask some very pointed questions. And they are things that we're going to look into on this subcommittee. But let me say this, it's important. Diversity is our strength. It has been our strength from the very first foundation of this country. It will make the agency, the CFTC, stronger, not only by the varied viewpoints and backgrounds that women, LGBTQ employees, and employees of color bring, but also through the credibility that the agency will gain by accurately reflecting the diversity of our great country. Mr. Chairman, it is my hope that you will take your colleagues' thoughts and concerns to heart and move forward in a constructive manner on this very important issue of diversity. In closing, I want to recognize the work of our Chairman Giancarlo, and all that he has done, and the openness with which he has approached his interactions with me and with the committee. It is certainly a roadmap for a productive relationship that I hope subsequent chairmen will follow. Now with that, I would like to recognize my ranking member, the other distinguished Mr. Scott from Georgia, for 5 minutes.
Thank you, Mr. Chairman. I want to congratulate you on the chairmanship, and we've had a great relationship for 25 plus years, and I look forward to continuing that. And some of the best discussions we have are in a Delta 10C and 10D seat, and a good opportunity for us to speak about things that matter on the way home to our state. So I also want to welcome the new members to the committee. And of course, Chairman Giancarlo, I know your wife is here with us today, so I want to say a special thank you to her for her service as well as yours, and ma'am, welcome to the hearing. Good to have you back here one last time before you and your family head back to New Jersey. Your service at the commission has been honorable, and I want to thank you for that, and I've appreciated the opportunity to work with you over the last couple of years. We've got some unfinished business, reauthorizing the CFTC. This committee and the House of Representatives has moved in a very bipartisan manner 3 times in the last 6 years to send a bill to the United States Senate. Chairman Scott and I have worked together on that, as well as the other committee members, and here we are. We're going to do it again, and maybe the 4th time will be the charm. As you know, last year, Darren Soto and I introduced the CFTC Research and Development Modernization Act. The legislation would modernize the CFTC research and information programs and provide the Commission with new tools to engage with developers and learn about technology. This bill was developed in response to a testimony that you gave, Chairman, about the difficulty in engaging with the private sector. And I look forward to hearing more about the work you're doing to engage on fintech, so that we as the committee can gain a better understanding of the needs of this bill as we work to refine it. Mr. Chairman, over the last 5 years, you've been a consistent voice for reason regarding some of the most complex work this committee engages in. And again, I appreciate your steady hand in the negotiations over how to regulate cross-border derivative transactions and other complex issues. And while halting progress and moving goalposts have been frustrating for me to watch, it's been comforting to know that you've been our man in the room, and we look forward to your testimony on where we stand and what work your successor has left to do. For 9 years, we've been promising end users they would be held harmless as we impose new regulations to protect financial markets from opaque risk, and how we complete these international negotiations are key to that promise. So this is one of the most important facts this committee cannot forget. The markets must work for the people who need to manage risk. Chairman Giancarlo, in closing, I want to say thank you again. Today's hearing might be a little more like an exit interview than a typical hearing, but I think it's a good place to start this new Congress with all of our new members on this subcommittee. Look forward to your wisdom and leaving us with a bigger picture of the importance of these markets and the regulatory structure and getting it right. And so thank you again. Ma'am, thank you for being here. And Mr. Chairman, I turn it back over to you.
All right, thank you very much. And now I recognize our distinguished ranking member, our distinguished former chairman, and my friend, Michael Conaway, for any opening statements that he would like to make.
Well, thank you, Mr. Chairman. I would not normally say much at this juncture, given the good work that this subcommittee needs to do. But congratulations on you becoming the chair of the subcommittee. You and I worked in a similar role when I was chair of the subcommittee, and you were ranking member. So congratulations on that. I appreciate your indulgence for letting me say a couple of words about my friend, the distinguished chairman of the CFTC. First off, Chris, thank you. Thank you for your service. Thank you for your diligence, thoughtfulness, and candor. And thank you for your relentless curiosity. And most of all, thank you for your bottomless reservoir of optimism. Everyone on this dais knows how hard it is to hold a position of public trust, but you never once have shown that burden. Rather, I've seen a man engrossed in understanding the burden of others and consumed with understanding how his work might ease their difficulties. I saw it firsthand when you came to San Angelo. Your speech lit up a room of oil men by connecting challenges found in the oil fields of Texas to financial markets in New York and around the world. And then you graciously talked to every person and shook every hand in the hour it took you to get out of the room. I also saw in the letter that you wrote to the Congregation for the Doctrine of the Faith at the Vatican. It's strange to think of a letter about derivatives as moving, but your careful explanation of why derivatives are important to the most vulnerable among us was a moving reminder about why these markets matter and why this committee should be diligent in its work in this area. I also want to thank your family, your wife Regina, your children Henry, Luke, and Emma, and recognize their role in your success. For the last 5 years, they've had to patiently share your time and attention with strangers. No doubt there may be some doubt, no doubt they're looking forward to having your undivided attention as you move into this next chapter. So let me close by saying that, first off, you closed your own testimony noting that you tried to do what your parents taught you, and that is to leave places that you visit better than you found them. So let me close by saying that you learned that really well. The CFTC is a better place because of your tenure as chairman. I suspect that this committee is also a better place because of your service. You worked hard to break down the ideological divisions and present positions supported by evidence and experience that were not rooted in the pitched battles of the past. I've greatly appreciated the opportunity to work with you and to learn from you these past 5 years. As you return to New Jersey, I don't suspect you'll be retiring in any of the traditional senses. I have no doubt that you will continue to put your intellect, passion, and values to work on behalf of the public. And as you pick that next path, I wish you your well-earned happiness, success, and Godspeed. Before I yield back, Mr. Chairman, I too want to add my condolences on the passing of Commissioner Bart Chilton. I did not know Commissioner Chilton as well as some of you in the audience, but I knew him well enough to know that he cared deeply about his work. In a career that ran from Capitol Hill to the Whitten Building to the CFTC to his farm in Arkansas, his unwavering focus was on how the government can protect the most vulnerable. I appreciate the opportunities I had to work with him and know that he will be missed. His family and friends are in my prayers and thoughts as these difficult days ahead. With that, Mr. Chairman, I yield back. Thank you.
Thank you very much, Ranking Member. And now I recognize our distinguished committee chairman, Mr. Peterson, for any opening statement he would like to make.
Thank you, Mr. Chairman, and I want to associate myself with the remarks of the ranking member about Mr. Chilton. He was a great public servant and somebody I worked with a lot in a number of different capacities, and it's a shock to all of us what happened there, and so our thoughts and prayers are with his family. And Mr. Chairman, welcome back to the committee. I think the last time you were in this room, we were playing guitars together, right? That's probably more fun than with this, huh? But anyway, we appreciate you coming back to the committee, and we appreciate the job that you've done over at the CFTC. I think you've done an outstanding job, and you've been very good to work with and very transparent. And I'm not happy to see you leave, but it's part of the way it works. So thank you so much for your service, and good luck with whatever you're going to do going forward, and we'll look forward to your testimony. Thanks for being here. Thanks. Yield back.
All right. Thank you, Mr. Chairman. The chair would now request that other members submit their opening statements for the record so the witness may begin his testimony and to ensure that there is ample time for questions. And certainly, Chairman Giancarlo, I certainly welcome you as our witness, and I share the parting remarks that our ranking member and our chairman made. Hate to see you go. We've had a great and long and a very beneficial partnership and relationship with you and with the CFTC. So now I'd like to open it up to you, welcome you, and thank you for being here. And we will now proceed to hearing your testimony, Mr. Chairman, and so you will have 5 minutes to give your prepared remarks.
Thank you, Chairman Scott, and Ranking Member Scott, thank you, and Committee Ranking Member Conaway and Committee Chairman Peterson, thank you all for that, and thank you for those kind remarks. Before I begin, I would also like to add my note on the recent passing of former CFTC Commissioner Bart Chilton. And on behalf of the CFTC, I want to say all of us are deeply saddened by his passing. You know, I came today and I'm wearing my CFTC pin. I don't normally wear it on committee appearances in deference to the oversight of this committee over our agency. But I wore this pin today because this one is actually given to me by Bart Chilton. And when he gave it to me, he said, wear this pin with pride because you're working for the finest agency in all of Washington. And I wear that today in memory of Bart. I understand today would have been his 59th birthday. He was a very fine public servant, and I just want to add my note of condolences to him and his family. We'll miss him very much. 2 years ago, as I took up the gavel as chairman of the commission, I promised to transition the CFTC from a rear-view focus on the last financial crisis to a forward vision of derivative markets as essential to economic growth and broad-based prosperity. And I set out a 3-part agenda: to foster economic growth, to enhance U.S. derivative markets, and to right-size our regulatory footprint. First, we announced Project KISS to make existing rules simpler, less burdensome, and less costly. We created the Market Intelligence Branch to better understand the rapidly changing markets that we oversee. And we hired a world-renowned chief economist to make us a smarter, more quantitative data-based regulator. We also launched Lab CFTC, one of the first and most influential fintech innovation initiatives by a U.S. market regulator. To enhance financial markets, we worked with other U.S. and overseas financial regulators to support bank capital requirements and leverage ratios that better balance systemic risk concerns with healthy economic growth. And we proposed a better regulatory framework for swaps trading and execution. We championed cross-border regulatory deference to competent overseas regulators while resisting global regulatory overreach. And importantly, we refocused our attention on agricultural commodity markets, the agency's traditional foundation. This year in Kansas, we held the CFTC's 2nd annual Ag Futures Conference along with K-State University. And we also hosted the first ever CFTC Ag Advisory Committee meeting held outside of Washington with all 5 commissioners in attendance. On behalf of the CFTC, I've been fortunate to visit agriculture producers in over 24 states, from South Dakota, Texas, Arkansas, Indiana, and Iowa, to Minnesota, Missouri, New York, Georgia, Mississippi, and Illinois. And I've walked in wheat fields and harvested soybeans. I've tramped through rice farms and beneath pecan groves. I've milked dairy cows and toured feedlots, and I've visited grain elevators and viewed cotton gins. And throughout, I've been moved by America's hardworking families producing food and staples from this abundant land. And it's for them that we've reset our regulatory footprint by conducting agency affairs with regular order and procedure, with thorough econometric analysis, and a reduced docket of new rules and regulations to be absorbed by market participants. But at the same time, we've been resolute in holding market participants to the highest standards of conduct. In fact, by any measure, enforcement has been among the most vigorous in the history of the CFTC, including more enforcement actions, more penalties, more large-scale matters, more accountability, more partnering with criminal law enforcement, and more whistleblower awards than in any prior year, in fact, in the entire history of our whistleblower program. By almost any measure, we've been enforcing the law with determination and with gusto. Our goal has been to run a professional operation keenly responsible to the American taxpayer, who are our ultimate shareholder. Looking back, I feel we've stayed true to this agenda. Now, looking forward, before I leave the Commission, I intend to maintain a steady but brisk course, advancing policy proposals on cross-border regulation and position limits, to progress rule harmonization with the SEC, to stay focused on initial margin implementation and the move away from LIBOR, and to defend our markets against threats, whether those threats are cyber maliciousness or a result of geopolitical events such as Brexit. If I've been consistent in anything in my almost 5 years at the CFTC, it's in voicing the value proposition of derivative trading markets as foundational to U.S. economic health and broad-based prosperity. Robust markets for commodity and financial derivatives make it possible for Americans to find plenty of food at stable prices in our grocery stores, affordable energy to warm homes and drive cars, and steady rates to pay home mortgages and invest their retirement savings. As I end 5 years on the Commission, I remain a champion and defender of free market capitalism, the disciplined and independent financial regulation that safeguards it, and the outstanding work of the CFTC. I greatly appreciate the thoughtful oversight of this committee and this subcommittee, and I'm grateful to my wife and my family for their love and support. And I thank God for the blessings of having led the fine men and women of the CFTC and having served this wonderful country. Thank you very much.
And thank you, Chairman, for that very informative and indeed touching presentation. It's evident of why many of us hate to see you leave. Great experience. I'd like to start, and I'll start with this question. I have long been concerned and worked with you, as you know, through the years on our cross-border. Right now, our derivative swaps, that area is valued at over $820 trillion piece of the world's economy. But we need to get our arms around this issue with Brexit.
Yeah.
It is presenting some very troubling winds that I think we need to look at. And I've done some background on it, but I'd like to get your perspective on this whole issue and the impact on our markets and our market participants. This Brexit thing keeps worrying me. My understanding that, of course, the United Kingdom is in the middle of what I call a drawn-out, bitterly difficult divorce from the European Union. And Prime Minister May has negotiated a withdrawal agreement with the EU last year, but Parliament has voted it down 3 times, even though a UK exit without an agreement promises nothing but chaos. The EU gave the UK an extra 6 months to come up with a way to leave on negotiated terms. But so far, there is no deal, much less any consensus on how to move forward. So, Mr. Chairman, during your negotiations with the Europeans on swap trading venue equivalents, you have been closer than anyone here to the process of the UK leaving the European Union. It seems that there is a desire in Europe to make it pretty hard on the UK for deciding to leave the Union. Have you seen any of those attitudes bleeding into your discussions on equivalence?
Thank you for the question. It's a very complicated subject, as I think you've outlined in your remarks. I think it's appropriate for the United States, and as a public official in the United States, to make clear to our European friends on either side of the English Channel that we take no view as to what's entirely a European decision about Britain's staying or going and what that means politically for Europe. But economically, it has a tremendous impact on us in the United States. Mm-hmm. There's two sides to our derivative markets. There's our listed markets, our futures markets that trade on exchange, which in many ways may be considered an export business, an important export business for the United States. And the global swaps markets, which are not traded on exchange, are traded over the counter, of which U.S. banks and financial institutions make up as much as perhaps 2/3 of the liquidity provision in those markets. And yet that entire swaps market is centered in London. London has emerged over the last several decades as the servicing center of this global swaps market that in your remarks you referred to in the hundreds of trillions of dollars in gross size. And that marketplace, for historical reasons, has become centered in London. So as the regulator of both our domestic export futures business and of the swaps, or the U.S. involvement in the swaps markets, we've been keenly focused on the impact of Brexit on these markets that we're charged to oversee.
Yeah, I'm also very concerned. I want to be consistent with our time here.
Yes.
But I'm deeply concerned about something else, and that is there's this new EU law that's bubbling up, and it's called EMIR 2.2.
Yep.
Which could have major effects on our United States clearinghouses, potentially setting up the EU as a primary regulator over our own United States clearinghouses. This is a problem. And our U.S. clearinghouses, in addition to that, may even be required to fund ESMA, the EU regulator of all EU finance, through surcharges.
Yes.
Just for the privilege of their regulating us. I'm hoping that you will tell me that I've got it all wrong. I'm hoping. I know you are deeply engaged in the implementation phase of EMIR 2.2. Should we have hope that these dramatic outcomes can be avoided?
Well, I wish I could tell you you've got it wrong, but you've got it right, and to some degree you don't even know how right you have it. This new law, EMIR 2.2, which has passed the European Parliament, it is now going to a process where they write the technical rules, but the law has been passed. It assigns to a European body based in Paris called ESMA that you referenced, oversight over non-European clearinghouses, including potentially American ones, but deems them to be unqualified to regulate European ones. Mm-hmm. So they have the capacity not to regulate European clearinghouses, but to regulate non-European ones. It's completely unprecedented in the geopolitical realm. I know of no other body that has such powers, nor does it have experience in doing this because it's never regulated clearinghouses before. Mm-hmm. Unlike the CFTC, which in your opening remarks, you noted for 40 years we've been doing it as an independent agency, for another 30 years before that as part of the Department of Agriculture. So we've got 70, 80 years of experience regulating clearinghouses, And suddenly now, under this EMIR 2.2, we face the prospect of having to share oversight of our domestic American clearinghouses with a foreign regulator that's not competent to regulate its own clearinghouse, but is competent somehow to regulate Americans. I've said publicly, Mr. Chairman, that at least under my watch, and I know my pending successor, Heath Tarbert, has said the same thing, this will not happen. U.S. markets will stay under U.S. regulation under the oversight of its respective committees in Congress. That is our constitutional system, that is our duty, and that is the way it will remain.
Very quickly, yes or no, in your view, is there something at work here where the EU is trying to wrestle the clearing business in particular and the financial services business in a general way from London?
I believe so.
Okay, thank you. Now I will yield 5 minutes to our distinguished ranking member, Mr. Scott.
Thank you, Chairman. Chairman Giancarlo, with regard to CFTC R&D Modernization Act, you discussed that in your testimony. You've obviously helped us with that legislation. I hope that we're able to include it in CFTC reauthorization this year. And my question for you is, while the focus on this legislation has been on the expanded transaction and gift authority, it also reorients the Commission's statutory research and development purpose. Can you talk about the importance of having a focused plan for research and development activities?
Absolutely. You know, when I meet with farmers and ranchers around the country, they often will say to me, what's going on in the markets? These markets are driven by algorithms and high-frequency traders, and we feel like we're being run over in the markets. Mm-hmm. Well, they're right. The markets are changing dramatically. They're moving from human markets to computer-driven markets. And if we're going to provide the function that Congress requires us to do to oversee these markets, we need to keep pace with those changes in the markets. Some of our overseas regulators, such as in the UK, are actively participating in new technological advancements to see whether they can both help the regulator to keep pace, but better understand the markets. In many cases, we found we're prohibited from participating in new technological innovations because if we were to participate in what they call proofs of concept or beta tests of technology, it would be considered a gift to the agency. And we couldn't accept a gift, we would have to go through a procurement process. And as I understand the legislation would allow us to participate in some of these technological innovations in a way that would benefit the agency to do its job so we can make sure these markets stay safe and sound and able to be used by our American agricultural and commodity producers.
I'm going to come back to that word gift in a second, but I want to talk about fintech and 21st century regulating. Can you talk more about Lab CFTC with regard to the R&D Modernization Act and how it can help the agency explore new tools that will help improve the regulatory and oversight activities?
Absolutely. So as they say, things are rapidly changing. Just as in every element of our lives today are going from analog to digital, so are our markets. And there's a lot of innovation going on right now, and innovators will come to the agency and often be faced with regulators who are familiar with a rule book, but not necessarily familiar with their technological innovation. And Lab CFTC allows us to have a dedicated team within the agency that are familiar with some of these technological innovations that can help translate the language of innovators to language we are traditionally used to in our markets. It provides a stakeholder within the agency who is focused on technology change and can help us understand it and adapt to it and evolve with it.
So one of the issues is how fast things are changing, as you've said. And we've got the Gift Acceptance Authority.
Yep.
And I think that those three words perhaps give a false impression of what is actually happening when somebody shares something with the Commission. Can you talk about what a gift is in the context of the Commission's budget and what sort of a gift the Commission is seeking to accept to further its research and development mission?
I'll give you an example that we're facing right now. So there's this new innovation called the blockchain. The blockchain potentially could have enormous transformational advantages for us an agency to be able to actually see trading in the market in real time and to see the counterparty exposure of one large financial institution to another in real time. Right now, we do that the old-fashioned way. We get data from the market, and then we try to piece it together, and hopefully we can understand. But if we could participate in the blockchain, we could see it in real time. We've been offered the opportunity by many innovators to actually participate in blockchain experiments. But I've been advised by our general counsel's office that if we were to participate, it would be considered a gift, which we couldn't accept. And so we're missing out on participating in these innovations that are going on right now, which ultimately we've got a role to play in them. We should be in these innovations. And as I understand the legislation, it would allow us to participate and not deem our participation as a gift under the law, which we could not accept.
I think that's an accurate portrayal of what we're trying to accomplish, and whatever the language is, if we need to make minor language changes, I want my chairman to know that we simply need to get you the authority to be able to participate in these, so that we as the regulators understand better what's happening in those fields. And so again, I'll yield the 24 seconds that I don't have back. But I want to thank you for your service, and ma'am, thank you for your service as well.
Thank you. And now we'll recognize Ms. Berger for 5 minutes.
Thank you very much, Mr. Chairman, for being here today. And thank you to the chair. I spent most of my career as a CIA case officer, and as someone who's been deeply involved in counterterrorism efforts, I know how vital it is to follow the money, and how these efforts can illuminate and track down terrorist groups and prevent future attacks. A recent RAND report concluded that if a future cryptocurrency provided better anonymity than Bitcoin and became widely adopted, it could be particularly useful for terrorist organizations and therefore make it much more challenging for our intelligence and law enforcement agencies to counter. The current U.S. regulatory approach to cryptocurrency is a patchwork and involves SEC, IRS, DOJ, Treasury Department, as well as the CFTC. What would you say is the biggest gap in cryptocurrency regulation right now? And do you think new regulatory authorities are needed to address the security concerns surrounding cryptocurrency?
So the gap right now are spot cryptocurrency platforms for spot, not derivative. Cryptocurrencies, non-ICOs. That's the gap between ourselves and the SEC that exists. Now, FinCEN examines them for money laundering purposes. There is state regulation that is partial, not comprehensive. But we do not regulate non-derivative trading platforms. We don't have the requirement that they register with us or subject to our oversight and supervision. So that is the gap that exists.
Okay. Would you make any just broad brush generalizations of recommendations of where we could close that gap and how, from Congress's perspective, we could, anticipating future concerns, be able to address those gaps?
Yeah, so if it's on the derivative side, as it is with Bitcoin futures, we've got it, and it fits within our traditional capabilities. If it's security, if it's like a security, then the SEC has it. So we work very closely with the SEC. We have an ad hoc working group on cryptocurrencies, and I could see how that ad hoc working group could be further developed into something that could be more routine if it were adequately funded by Congress, and could, with some extension of jurisdiction, legal jurisdiction, could take a more active role on those spot exchanges. Right now, we don't have the legal authority and we don't have the resources, but with resources and authority, that's something that could be developed.
Thank you very much. My second question, switching gears, is talking about LIBOR. With the transition from LIBOR to SOFR as the new recommended benchmark being voluntary, I am particularly concerned about farmers in my district.
Yep.
in Central Virginia who have loans based on the LIBOR, as well as other constituents who have business loans, mortgages, and student loans that are currently based on LIBOR and could be affected by this transition. I know that the CFTC's Market Risk Advisory Committee has been working on this transition, and based on the current state of their work, what is the plan to make sure that these transitions happen smoothly, to communicate these transitions, and to provide stability for farmers, homeowners, and others who might have loans based on LIBOR?
Yeah, thank you for that. It's something we've been very focused on, and the work of the Market Risk Advisory Subcommittee on LIBOR has been doing some great work in this area, as has a number of work streams, both domestically and internationally. If I can just take a moment, because your constituents are probably wondering why we need to move away from LIBOR. Well, LIBOR was something that was started 30, 40 years ago when banks actually financed themselves by lending to each other in overnight markets. Over the last several decades, that's dwindled down to less than a dozen trades a day and less than $1 billion dollars worth of trades a day of banks lending each other. Banks simply don't finance their operations with overnight lending anymore. They use repo markets and other longer dated instruments. So there's virtually no LIBOR market left, and yet we have trillions of dollars of loans, some to your constituents, that are based on a rate that doesn't, on a market that doesn't really exist anymore. It's like a house that only has one stone left as its foundation and could collapse at any time. And that's why, in an act of, I think, great responsibility, world financial regulators have said, let's not wait till the crisis happens, let's take steps in advance of the crisis to move to another rate. And the rate that's been selected through a combination of regulators and industry is called SOFR, the Secured Overnight Rate, which is based upon how banks actually do their overnight funding, or their dated funding, their lending funding, their repo funding. It's a much more stable rate. It's now been tested. And to get to the answer to your question, there's been a lot of development on it. Our exchanges at the CME and ICE have launched futures based on this, so there'll be some pricing point references for the new rate, and it's had great success in the development of that. An organization called ISDA, the International Swaps and Derivatives Association, is working on protocols that the marketplace will use for how the transition works. And there is a timeline. We're in a very critical phase, but I must say every milestone that's been set has either been reached on time or early so far. The public-private partnership to move away from LIBOR is working very well. There's more mountains to cross, but we've crossed many so far, and I'm optimistic we will get there within the next several years.
Thank you very much. I yield back.
Thank you. Now we'll recognize Mr. Crawford for 5 minutes.
Thank you, Mr. Chairman, and Mr. Giancarlo. Chairman, thank you for being here. I'm going to frustrate my staff a little bit and go off script. I had some questions I was going to ask you, but something's on my mind, and I think we've had this conversation before, and I probably wouldn't have asked it this way 2 or 3 years ago, but being that you're starting a new phase in your life, I'm going to ask you to speculate, which I wouldn't ordinarily ask. But you mentioned this before, that you've visited farmers and ranchers, you've walked rice fields, and you've been out there, and one of the things that I hear from my farmers back home is just really a fear in participating in the market.
Yep.
And so, to me, what we've lost, and the irony of the fact that this is the Ag Committee, and this is the kind of thing that we're supposed to be talking about to provide a level of support to our farmers and ranchers who provide the very food and fiber that we rely on. But we have blocked them, in effect, from participating in what is, I think, the quintessential capital market and the free market tool that they should be using to secure their production. And so when I suggest to farmers, you really need to rely on a hedge instrument. Primarily, I suggest options, because the fixed cost nature of options and their ability to you don't have to make margin calls, and there's a level of security there. And they're just afraid. And what that contributes to is, I think, greater volatility. And what it points to, and you mentioned this before, is, we've got algorithms and we've got hedge funds and we've got all these other things that keep farmers from participating and being a part of price discovery, which they relied on up to really just not that long ago. but they're afraid to get in it. And I wonder if you can offer some suggestions or some reassurance on how we get farmers back in the market, creating that liquidity, and I think stabilizing the market basket.
Thank you for that, and I'll let me free think on this because it's the essential question. When you put it very well. These markets serve two purposes for our commodity producers: to hedge their risk, price risk for the most part, and to provide a stable price point. So even if they're not engaged in the markets, when they go to the grain elevator, when they sell their production, they're looking at a price point that comes out of the exchanges, and that's where they're negotiating price on, and they want to know it's a reliable price. They want to know these markets are not manipulated, whether they've been manipulated by old-fashioned bad guys or whether they've been manipulated by algorithmic trading or other new technologies in the markets. And that's what keeps us at night at the agency, is thinking about how are our markets changing, and are they changing in a way that is distorting either that price discovery point or the ability to hedge production. And they are changing rapidly, just like everything else in our lives, whether the way we hail a taxi today or book a hotel room, our markets are going through that same digital transformation. And it's a force much bigger than any of us. It's not like we're going to get out there and say, stop, these markets have to stay analog, because we'll get run over. We can't stop it. What we have to do is understand it. And we have to stay in pace with it, and then see where, if there's distortions, where they are, and take steps to address it, which is why we need this new authority so we can be involved in all these technologies. But our farmers and ranchers are smart people. I mean, they know things are changing. They can sense it all around them. Sometimes when I talk to them, I feel like I'm talking to somebody who could be a car driver driving a Ford Pinto down a 2019 highway and getting passed by much faster vehicles, much more vehicles that can turn on a dime, can stop on a dime, and that's what these algos allow their users to do. It's not just about high-frequency trading. It's about just the sheer ability of them to change and morph and use artificial intelligence to learn from what else is going on in the market. I mean, it's a really dynamically, rapidly changing market, and the challenges of us keeping pace, which is why we've brought in a world-ranked chief economist. It's why we've created a market intelligence unit. We really need to focus on understanding the evolution of these markets and coming up with some answers to whether there's manipulation, whether there's still a fair deal for the individual user of these markets. And I think options are a way that I've seen a number of ag hedgers use successfully. But I think the old-fashioned futures product is still a good product as well. So I've stated for you a lot of concerns, but through those concerns, I fundamentally believe our markets remain sound. In fact, the use of our markets has only grown, not diminished. They've become global markets, just as our ag products are a global export product. Our futures markets are used by users the year round. Argentinian wheat growers use the price out of Chicago. Brazilian cattle farmers use the live cattle product. I mean, our markets have only grown in global stature despite all these changes. So it's a complex area. It's been my great pleasure to focus on it for the last 5 years, but these challenges are not going away. They will remain and they will grow. Challenges and opportunities, I should say.
Let me thank you for your years of service, and to you and your family, wish you all the best in your future.
Thank you, Mr. Crawford.
And now recognize the gentleman from New York, Mr. Maloney, for 5 minutes.
Thank you, Mr. Chairman. Nice to see you again, Chairman Giancarlo. Last year, we heard from the former Chairman Gensler and your Chief Innovation Officer. We heard from you a couple weeks later on the subject of cryptocurrencies, and you touched on this with my colleague from Georgia. But I wanted to invite you to say another word on this subject. There's still a lot about it I don't understand, but I'm very interested in it. And I'm interested in the issues that it poses for capital formation and risk transfer. I'm interested in the impact it has on the capital and derivative markets. Like you, I believe it's transformational and presents an enormous opportunity, but it comes with some opportunities to screw it up as well. So I'm hoping you could say a word. There was broad agreement last year that the CFTC has a greater role to play here, and that's going to require some changes to the Commodity Exchange Act. Could you say a word about that and what changes we should be considering to the CEA?
There could be some changes in terms of jurisdiction, as I mentioned before. I think our existing tools, though, allow us to oversee areas of cryptocurrency derivatives. As you know, we have cash-settled cryptocurrency derivatives that have come through our process and have worked quite well. In fact, the San Francisco Fed did a study that said that more than anything else, it was the launch of CME's Bitcoin future that popped the Bitcoin bubble. And I take great satisfaction in that, because the knock on regulators coming out of the last financial crisis is that they didn't see the bubble building and they did nothing. Well, in the first post-crisis bubble that we saw in 2017 in Bitcoin futures, it was actually a market-based product overseen by our agency that did more than anything perhaps to correct that bubble. And so I think that's an area of some satisfaction. We do find the issue of physically settled Bitcoin more of a challenge, because it comes down to where are those Bitcoins housed in a physically settled Bitcoin. And the way our statute works is, while we have oversight over clearinghouses, when it comes to actual custody, it's usually done through state-based organizations, banks or trusts. And so physically settled presents more novel challenges for us, which we're working through a number of applications right now. I'm not sure we need new legislation in that area, but it's something that if we did, we would certainly come to.
Just because I have limited time, you wouldn't make any changes to CEA?
I do think we do need to think about the spot-based exchanges, but for derivatives, I don't have any recommendations to make at this time.
And what about the potential for a race to the bottom if the U.S. doesn't lead in this, and we see, international markets regulating in an inferior way? And could you also say a word about how we can assure people that this is something that's good for them, for their families? There's a tremendous lack of understanding about the nature of cryptocurrencies. I think some of the press around it has been quite scary in terms of its ability to kind of facilitate wrongdoing. The old Silk Road website, the rest. Can you say a word about sort of concerns about race to the bottom, number one, and number two, about just how we assure people that this is something that's good?
Yeah, so I think we have the challenge of both a race to the bottom with some jurisdictions. We also have a race to the top with some jurisdictions. France, for example, has just put forward a very forward-looking new law, the PACT Act, on encouraging coin offerings to take place under French law. And there's a number of other jurisdictions. Germany's looking at one right now. So I think there's both challenges to us in the United States that this may develop offshore in a way that would be hard for us to control, and our citizens could be taken advantage of in race-to-the-bottom jurisdictions. But I think there's a challenge that other jurisdictions will come up with some really good legal protocols that will attract business that will then miss out in the United States. The reason why I think cryptocurrencies, crypto assets are here to stay is because I think a good portion of the globe, maybe a third or more, does not have a functioning currency. And you're already seeing new payment systems outside of our bank-based payment systems take place in places like Southeast Asia and others. And I could see how crypto assets could be perceived in many parts of the world as far more stable than the nominal currency used by their governments. If you visit parts of the developing world, their local currency may be sufficient to buy vegetables in the local market. But if you want to buy a Toyota, they won't accept the local currency. They're going to require a hard currency like the dollar or the euro. And yet I could see where those jurisdictions could go to a crypto asset-based currency. So, we're in a dollar-based jurisdiction. We don't often think about challenges to the dollar. But I think long-term, there's many parts of the globe that are searching for something that's electronic, that's stable, that's mobile telephone-based. And I could see where you could see crypto assets taken off in many parts of the globe.
Thank you. Yield back, Mr. Chairman.
Now I recognize the lady from the Virgin Islands, Ms. Plaskett. Oh, I'm sorry, Ms. Rodson.
That's all right, Mr. Chairman.
My apologies.
Thank you much. Mr. Chairman, let me add my voice to those who have thanked you for your service. It's been very, very commendable, and really appreciate you being here today. Late last year, you proposed a significant overhaul of the swaps trading rules. I know this is an area you feel very strongly about and have worked very hard to be thoughtful and deliberate in your approach. I'm interested in two particular aspects of your testimony, the reliance on staff interpretations and guidance and the potential impacts to liquidity during a crisis. First question, can you elaborate on which parts and how much of the SEF trading rules are dependent on staff interpretations and guidance? And then why should we be concerned about that?
Well, thank you very much. So I think broadly, whenever regulators operate through no action relief or staff guidance, that makes it easy for large institutional players in the markets to hire the lawyers necessary to parse through those no action relief and know what they can do and what they can't do. But it makes it very hard for new entrants in the market that may not have those type of big law firm resources to go and know where the law is. And I think that it's always better to have our rules clear and easily understandable. Our SEF regime right now is held up in a whole range of key areas by a series of no action relief, by a series of staff guidance, and in many cases by simply staff forbearance of enforcing some of the rules. And so my SEF proposal would be to incorporate all those into the proper text of the rule and to make it clear. But it also would make our system, as I believe Congress intended to be, much more flexible in approach. The current rule set really, I think, flies in the face of the clear instruction of Congress for flexibility. It's very prescriptive, and it's overly based upon the listed futures market. But I think more broadly, our markets compete on a global basis day in and day without markets. And why shouldn't we have the best regime? I've always said the goal is not to have either the most regulation or the least regulation. That's a false argument. We should have the best regulation. We should have a regulation that attracts new entrants, new business models. You know, since our rules went into effect, we've had no new entrants come into this space. We've had no new trading protocols. We've had no innovation. And as Americans, to have no innovation just goes against our nature. It goes against who we are. And I'd like to bring innovation back to this area of the market.
So there's some market participants, obviously, that suggest the proposed changes would impose significant cost on them. What are your views on, rather than having a major overhaul, having more of a targeted approach?
Yeah, so there are those who believe we can tinker around the edges and just take some of that no action relief and codify it. But we're still left with a regime that's overly prescriptive, a regime that's based upon the wrong model, which is a listed exchange model. And I think a regime that would really squelch innovation as the current regime has done.
Moving on, I've got a couple other topics I want to hit real quick. Last week, the CFTC's Energy and Environmental Markets Advisory Committee meeting included a discussion about the SACR proposal, its impact on energy derivatives. You know, I'm a little bit concerned about that because many of the advisory committee participants indicated that if the proposal is not changed, it would reduce the ability of energy companies to hedge their risk, and the resulting volatility would be passed on to ratepayers. Can you explain what these energy firms are concerned about and share your thoughts on the matter?
I'm really glad you asked that question because it's a very important matter, and it's one that's right before us right now, and the time to fix this is now. The global standards emerged in the wake of the financial crisis on dealer capital, and I think we're a great supporter of those. I believe in those reforms. But in some cases, U.S. regulators have gold-plated those international standards and added additional requirements on top of them. In the case of what's called the supplementary leverage ratio, our U.S. prudential regulators at the Fed, the FDIC, have gold-plated those standards, and the OCC have gold-plated those standards by adding an additional 40% capital requirement on energy, and not just the more volatile energy products, but also in some relatively stable price points like natural gas. And this gold plating is not borne out by any type of data that shows it's necessary. But what's increasingly clear is it's going to have a cost all the way down the energy food chain and to impact consumers, institutional and residential consumers of energy with additional costs that are really not borne out by systemic risk concerns. So it's an area that at our Energy and Environmental Markets Committee we explored. We've looked at some very good data, and my fellow commissioners and I, on a bipartisan basis, Republicans and Democrats, have written to our fellow regulators asking them to reconsider this gold plating so that we don't impact our U.S. energy consumers and energy users.
Thank you very much. My time's expired.
Very much. Now recognize the young lady from Iowa, Ms. Axney.
Thank you, Mr. Chairman, and thank you, Mr. Giancarlo, for being here. It's a pleasure to meet you on what appears to be some of your last days in this position, so pleasure to meet you. You just heard I'm from Iowa. My apologies, I just came from another event with some folks from Iowa downstairs, and a lot of them in agriculture. You want to express that I'm concerned, and of course Iowans are concerned about agriculture and where we're at, and certainly our farmers are concerned. And the recent Ag Economy Barometer report in March was, I'm sure you know, at 133, down from 136 in February. And when farmers were asked if they were less optimistic about the future, 52% agreed that they were. I understand why they feel this way, of course. They're facing uncertain trade markets, and in China in particular, of course, they're looking at a lot of alternative trading partners, so we're losing those businesses. And of course, we're waiting for those tariffs to stop and for trade negotiations to conclude. So, I want to ask you, in thinking about these things about our futures, and would you agree that the uncertainty over tariffs and trade agreements brings volatility into the commodity prices and our futures markets?
Yes.
And the longer the trade agreements linger unresolved, will it have a negative impact on the stability of our markets?
It certainly impacts volatility in the markets.
Appreciate that. And of course, we've seen a devastating increase in small refinery exemption waivers from the renewable fuel standard, and that absolutely affects our ethanol supply in Iowa. And are you seeing impacts from that in the futures market?
We're certainly seeing impacts from in ethanol in the recent flooding that's been devastating for the area, and transportation costs have had an increasing impact. One of the things we do at the Commission is we look at our commodity prices daily, and we do a weekly recap every Friday, and we look at all the impacts that are triggering volatility, whether they be tariff issues, whether they be political risk, whether they be weather-related risk. And it's not ours to determine whether the price is right, but we're always searching to see what are the shocks to the marketplace, and how is the market processing those inputs to make sure that the price establishment is fair, so that producers can rely on the price signals that come out of our markets and rely that they are accurately reflective of all the externalities that are impacting those markets.
Okay, appreciate that. Thank you. Moving forward, while prices for Brazilian biofuel, for example, have increased by 19%, ethanol futures were down for June by about 1% for 2019. And as we know in Iowa, we just talked about where ethanol goes, that's where corn goes.
Yep.
And as of, I believe, April 23rd, speculators held a net short position of 322,215 futures and options. Which is the U.S. Commodity Futures Trading Commission data that they reported. And this figure obviously measures the difference between bets on a price increase and wagers on a decline, and that's been the most negative, as I know you're aware, since 2006. Are you concerned about the impact that U.S. trade and policy decisions are having on the markets you oversee?
Yeah. So let me distinguish. Again, part of our discipline is it's not to determine whether a given price is a good price or a bad price for producers. I know prices affect producers, right? But as a markets overseer, what we're looking to see is whether that price discovery mechanism is accurate. It may be accurately setting a low price, which may be disappointing to many, but if it's an accurate price determination, then we've done our job. And so we're always looking at the range of externalities. We're looking at factors. And analyzing whether the market is doing the right job of establishing it, including the different roles of different participants in markets, whether they be speculators, whether they be natural hedgers, whether they be large merchandisers. We're always looking at the different roles at different, and I'm confident that the market is providing its essential function of working through all those inputs to come out with an accurate price point. Now, that price point, we know that prices have been falling in many commodity markets for American producers for the last several years, and in some cases, that may be almost reaching economic crisis point for many. But our job is to make sure, whatever the price is, it's fairly arrived at, and our markets are doing their job pricing it.
I appreciate that. I have lots of questions I'd love to ask you, but let me just close. Obviously, we also have ag land that's declining in prices, so I look at all these variables as creating volatility for our futures. And I'd ask you, as I go back this weekend again and talk to the farmers in my district, what should I tell them about their confidence in the markets right now?
Well, I think you can tell them they should have confidence in the markets. Now, they may not like the price signal coming from the market. I understand that. My experience with meeting America's farmers and ranchers is an enormous amount of respect and sympathy for the challenges they face. I think they have some of the most challenging jobs in our country, but I believe our markets are sound and operating effectively.
I will let them know. Thank you.
Thank you, and now I recognize the gentleman from Florida, Mr. Dunn.
Thank you very much, Mr. Chairman. Thank you, Mr. Giancarlo, for your time and effort here, not just today, but also in your agency. You've written extensively about the importance of derivative markets and how it protects consumers from price fluctuations in everyday items. I believe you have found a balance between smart regulation and over-regulation, over-burdensome regulation, and I think our country's better for that attitude. And it's when we get this wrong, it's not just bankers who suffer, it's actually the farmers and ranchers who depend on the stability of those derivatives to make a living. And I know that you have worked with SEC Chairman to prioritize the coordination, the harmonization of the rules that you share in swaps and hedges, and I wonder if you could describe to us the to-do list you have worked on, what you've checked off, and also what you're facing now going forward.
Yeah. So when I came into the chairmanship 2 years ago, one of the true disappointments I had is there was no harmonization effort ongoing between our two agencies, and yet there's so much. So many points in which our agencies have either overlapping or very close jurisdiction that require almost a continuous process. And so Chairman Clayton and I, one of our very first meetings, we sat down together and said, let's create an ongoing harmonization process, both in our policy areas, but also in things like our enforcement areas, things like our response to new emerging technologies like cryptocurrencies. And so we have a number of ad hoc working groups. One is to look at policy harmonization, rule harmonization, and that we have each nominated members of our commission. So in the case of our agency, it's Commissioner Brian Quintenz, and at the SEC, it's Hester Peirce, who lead this process of looking at policy harmonization. But then our heads of enforcement have a regular ongoing meeting to talk about enforcement cases. And we've done more partnering with the SEC on enforcement matters in the last 2 years than I think has been done in the history of our two agencies. And then also in the area of new emerging things like cryptocurrencies, where we've coordinated virtually every step we've made. We just last week put out an advisory to retail participants in cryptocurrencies to warn them about some of the risks in this area, and it was coordinated between our two agencies. So we've got an unprecedented level of cooperation. Now, in terms of actually policies, there's several challenges. One is in areas where our rules are set and their rules are set, and they may have different approaches. How do we bring them closer together? We're working on that in a number of areas that would require us to make some changes, for them to make some changes, and I'm hoping that we're on the verge of doing that very soon. The other area is in new policy matters. So, for example, the SEC right now is working on some capital rules and margin segregation rules. And we have already our rules in place. So we've been working with them to bring their rule set closer to where ours are so that when they go final with it, it's much more harmonious. And I think you'll also see some action on that with any bit of luck, even before I leave the commission, but certainly sometime this summer, I would imagine those will be finalized.
Thank you very much for that. Also, I want to thank you for the improved economic analysis that you've made a cornerstone of your time as chairman. I think good data can solve a lot of disagreements. Regarding that, as we contemplate the reauthorization of the CFTC, are there any statutory changes that would help support you with this high-quality research and analytic work on economics at the commission?
Yeah, so no statutory changes, but I think that the future for the agency has got to become what I call a quantitative regulator. We have got to be able to do data analysis on a par with the most sophisticated firms operating out of Silicon Valley in California, whether they be Facebook or Google. We've got to be able to do data analysis on billions and billions of data sets and on trillions of dollars of markets to truly take our place as the foremost global regulator of derivatives. And that's the future for us. And that's something that I think involves a long-term conversation with Congress, both in terms of funding and how do we get there. But if we're going to do our job in these markets, we've got to move ourselves from an analog approach to data to a highly digital, highly sophisticated, highly data automated process. The type of work that Facebook and eBay and Amazon do every day, we need to be able to do that same type of analysis of data in our marketplaces.
Well, thank you for your commitment to that, and we look forward to working with your department to make that happen. And Mr. Chairman, I yield back. Thank you.
All right, well, thank you. And now I recognize the gentlelady from the Virgin Islands, Ms. Plask.
Thank you very much, Mr. Chairman, and thank you, sir, for being here this morning. I wanted to ask you about something that was alluded to earlier, blockchain, but in the context of automated trading,
right.
Which is growing and has contributed to some of the market disruptions, and some automated trades aren't reflective of the true value of companies, but are actually related to the speed at which those transactions occur. Since probably more than half of the trading in agriculture futures is automated, what's the status of regulated automated trading, and when can we expect to see, or should there be any action from the Commission in this area? That's the first part.
Yep.
And then the second part would be, excuse me, how blockchain may affect this automated, and is that a mechanism by which you can be more reflective and monitor what's happening in this area?
Yeah. So my predecessor, Chairman Massad, under his watch, put forward a proposal called Regulation AT, which stands for automated trading. By some estimates, that proposal would have required over 2,000 automated trading firms to register with the CFTC. It also would have given the CFTC the authority to take control of their source code behind their trading mechanisms without a subpoena. I did not support that regulation. I thought it was overly broad. I didn't think we had the resources to take on 2,000 new registrants. And quite frankly, I thought that the taking source code without a subpoena was frankly unconstitutional. I didn't support that, and I've been clear that I don't support it today. What I do support, though, is I think what Chairman Massad was trying to get at in that regulation, which was better insight and understanding of the role of automated trading, whether it be that subset that is high frequency or generally the use of automated trading mechanisms in our market. I believe that's the right thing to do, and that's why we have created our Market Intelligence Branch. And our Market Intelligence Branch just released a study of the role of automated trading in their markets. And that study found that they don't materially contribute to volatility in the market. And I think that was an important piece of work. But we've got much more analysis to do on the role of automated trading in the markets. And I know our Technology Advisory Committee is going to take up what should be the path forward for the agency with regard to automated trading.
And what is your thoughts on that?
Well, I don't believe in a registration scheme. What I do believe in is market intelligence. I don't believe you can hold back technology. But what we need to know is where those technology changes if they are manipulating the market, if they are distorting the market, where they are. And that's where the search has got to be. But we don't yet have evidence that they are either distorting or manipulating or
And do you believe that blockchain is a mechanism by which that can be monitored or reviewed?
Yeah, so I think, and I've said this many times, I think blockchain could be for regulators a quantum leap forward in how we understand market, how we digest information. And so I'm a big supporter of the use of and development of blockchain in the regulatory process.
So in utilizing blockchain, you know, it's often attached in discussions to cryptocurrency and Bitcoins.
Yep.
Outside of cryptocurrencies, are there any new other asset classes that have come into the market since Dodd-Frank has been put in place? And what are those, and how should we in this committee be looking at those?
So our markets have a great track record of new innovation. Some of it are in old-fashioned new versions of different commodity products. Some are launched and don't gain traction and disappear. There recently was an attempt at a new cotton contract. It's a very old staple, but it was a new contract. Didn't gain, I think, the traction that its promoters wanted, but it's an example of some of the new products that we see. We continue to see new type of crypto assets coming to the market. I'm not familiar, though, with any technological innovation similar to those that have come about in the last 2 years, but that won't surprise me if there's something right around the bend that we haven't seen.
So, and before my time runs out, just something, an exchange I had this morning regarding aluminum.
Yes.
And disruption that may be perceived in the aluminum market, which are not entirely related to the tariffs that the president's put on. I know that Secretary Wilbur Ross acknowledged that there may be antisocial, as he put it, behavior in the marketplace related to Midwest premium and aluminum. Can you elaborate on that?
Yeah, so we monitor that very carefully for areas of manipulation. We've been looking at aluminum for years, and there's been concerns about that. But we have not found manipulation in the market. I think there are concerns about the way the index used by some of the index providers is constructed, but not from the point of view of manipulation, but from the point of view of just whether it is the way it's constructed leads to the most accurate pricing point. That's an area that's actually outside of our jurisdiction. We do not regulate the formulation of benchmarks. We only oversee where there may be manipulation that it would affect one of our derivative markets.
Thank you, and I yield back. Thank you, sir.
Johnson, 5 minutes.
Thank you, sir. I do want to save a couple of minutes for us to talk about the Sacker method, Mr. Giancarlo, but I want to give you an opportunity for 1 minute or two to talk a little bit more about Brexit. In the interest of time, the chairman had to cut you off. So maybe round out your answer a little bit and end with any sense of whether or not, you know, the end users could be impacted by Brexit.
Yeah. Well, I think that if London is substantially destabilized as the global processing center for derivatives, for over-the-counter swap derivatives, which is an enormous market, whether measured in notional or even net terms. There's something like 17 to 20 net notional of derivatives cleared in London. That is something that would work its way all the way into the real economy. It would affect interest rates. It would affect everything in the real economy. So we're very concerned and very focused, and we've taken a bit of a leadership role on this area at the Financial Stability Oversight Council of alerting them to concerns we have as to the destabilization of London. If that business were to leave London, it's a question of where it would migrate to and how that would be done. You know, we view the dollar and dollar-based instruments as a global currency and global instruments. We believe our markets are export markets. So we don't seek to dictate where the market servicing reside. If the dollar is truly a reserve currency, then clearing of dollar-based instruments can take place in London. But if London is displaced in that role, then we do have a concern as to where that goes.
And are there speculation about the 2 or 3 most likely homes?
Well, as the chairman noted, I mean, there certainly have been efforts out of Europe to force relocate some of that to the continent. London is unique in its skills, in its historic, in its common law based, in its ability to innovate. I'm not sure there's any place else in Europe that quite matches it. And we will have a concern as to the migration of that business because American financial institutions play such an outsized role in those markets. We're also concerned about efforts by our colleagues in Brussels to expand their jurisdiction over institutions outside the EU. As I say, we've got a long history of successful oversight of our domestic clearinghouses. Our domestic clearinghouses did not fail during the financial crisis. And I think some of that was by strong oversight by the committee that I have the honor to serve. And we would be very concerned about a new regulator without a track record of regulating these markets suddenly asserting their jurisdiction to do so here in the United States.
Yeah, I think that's well said. I do want to shift back to the SACR role, and I was impressed by the letter that you and your colleagues sent. I share your concerns with regard to the proposed rule and its impact on the supplementary leverage ratio. I was just mystified that you had to send it at all. To me, it's as clear as day that the proposed rule, if not changed, the real negative impact won't be to the big banks or the big boys and big girls that sometimes are made out to be boogeymen, but rather to low-volume traders, manufacturers, community banks, producers. Give me some sense. I know you've had some conversations with Vice Chair Quarles. Do you get the sense we're making any progress?
Well, so I'm loath for me to criticize any other agencies. I know how challenging it is to run an agency. But in my conversations with the head of those agencies, they understand the issue. I think the challenges in moving a rule change through and the bureaucracy and the challenge of doing that. And I can sympathize with that. I know it is. But as I said earlier, the time is now. We've got to get this right now. And no other important economy outside the United States has done this gold plating the way we have. There's no need to do it.
Very well said. Thank you for your time today, sir. Mr. Chairman, I yield back.
Thank you very much. And now we'll recognize the gentleman from Indiana, Mr. Baird.
Thank you, Mr. Chairman. And Chairman Giancarlo, we really appreciate you being here today.